Question 1. Which of the following entities is primarily responsible for establishing the rules and regulations for securities exchanges and broker-dealers in the U.S. to protect investors? A. The Federal Reserve Board, FRB. B. The Securities and Exchange Commission, SEC. C. The Financial Industry Regulatory Authority, FINRA. D. The Department of the Treasury. Answer, B. The Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is the primary federal regulatory agency that oversees the securities industry in the United States. Established by the Securities Exchange Act of 1934, its main goal is to protect investors, maintain fair and orderly markets, and facilitate capital formation. While FINRA creates and enforces rules for its member firms under the SEC's oversight, the SEC is the ultimate authority in establishing federal securities laws and regulations. Question 2. An investor purchasing shares directly from the issuer in an initial public offering, IPO, is participating in which of the following markets? A. The secondary market. B. The third market. C. The primary market. D. The fourth market. Answer, C. The primary market. The primary market is where new issues of securities are sold to the public for the first time by the issuer. An initial public offering, IPO, is a classic example of a primary market transaction, as it involves a company selling its stock to the public for the first time, with the proceeds going to the issuing company. In contrast, the secondary market involves the trading of existing securities between investors. Question 3. Which of the following best describes the role of a broker-dealer acting as an agent? A. The firm buys or sells securities from its own inventory and charges a markup or markdown. B. The firm facilitates a transaction between a buyer and a seller and charges a commission. C. The firm acts as an underwriter for a new securities offering. D. The firm provides investment advice for a fee. Answer, B. The firm facilitates a transaction between a buyer and a seller and charges a commission. When a broker-dealer acts as an agent, it facilitates a transaction between a buyer and a seller without taking ownership of the securities itself. For this service, the firm charges a commission. Conversely, when a broker-dealer acts as a principal, it buys or sells securities from its own inventory, charging a markup when selling to a customer, or a markdown when buying from a customer. Question 4. All of the following are typically considered money market instruments except A. Commercial paper. B. Treasury bills. C. Negotiable certificates of deposit, CDs. D. Treasury bonds. Answer, D. Treasury bonds. Money market instruments are short-term, highly liquid, and relatively safe debt instruments with maturities of 1 year or less. Commercial paper, treasury bills, and negotiable certificates of deposit, CDs, all fit this description. Treasury bonds, however, are long-term debt instruments issued by the U.S. government with maturities typically ranging from 10 to 30 years, classifying them as capital market instruments. Question 5. A mutual fund's net asset value, NAV, is calculated at the end of each business day. Which of the following factors would cause a mutual fund's NAV per share to increase? A. A decrease in the market value of the securities in the fund's portfolio. B. An increase in the number of shares outstanding due to new investor purchases. C. The fund distributes dividends to its shareholders. D. An increase in the market value of the securities in the fund's portfolio. Answer, D. An increase in the market value of the securities in the fund's portfolio. A mutual fund's net asset value, NAV, per share is calculated by taking the fund's total assets, subtracting its liabilities, and dividing by the number of outstanding shares. Therefore, an increase in the market value of the securities held within the fund's portfolio will directly increase the fund's total assets, leading to a higher NAV per share. Conversely, a decrease in asset value or the distribution of dividends, which reduces assets, would decrease NAV. Question 6. Which type of risk is specific to a particular company or industry and can be mitigated through diversification? A. Market risk. B. Systematic risk. C. Interest rate risk. D. Non-systematic risk. Answer, D. Non-systematic risk. Non-systematic risk, also known as company-specific or business risk, is the uncertainty inherent in a company or industry. This type of risk can be reduced or eliminated by diversifying an investment portfolio across different companies and industries. In contrast, systematic risk, or market risk, is inherent to the entire market or market segment and cannot be diversified away. Question 7. A registered representative opens a new cash account for a client. Which of the following is required for the account to be opened? A. A signed new account form from the client. B. An initial deposit of at least $1,000. C. A suitability review conducted within 30 days of opening. D. The client's date of birth and social security number. Answer, D. The client's date of birth and social security number. Under the Customer Identification Program, CIP, requirements of the USA Patriot Act, financial institutions are required to verify the identity of their customers. This typically includes collecting a customer's name, date of birth, residential address, and a taxpayer identification number, e.g., social security number. These items are a strict requirement for account opening to combat money laundering and terrorist financing. Question 8. Which of the following statements about common stock is true? A. Common stockholders receive fixed dividend payments. B. Common stockholders have a prior claim on assets in case of bankruptcy compared to bondholders. C. Common stockholders have voting rights and the potential for capital appreciation. D. Common stock typically has a par value that dictates its market price. Answer, C. Common stockholders have voting rights and the potential for capital appreciation. Common stockholders are the true owners of a corporation, possessing voting rights that allow them to elect the board of directors and influence corporate policy. They also have the potential for capital appreciation as the company grows, but dividends are not fixed and are declared at the discretion of the board. In contrast to bondholders and preferred stockholders, common stockholders have the most junior claim on assets in the event of liquidation. Question 9. A callable bond is most likely to be called by the issuer when A. Interest rates rise significantly. B. Interest rates fall significantly. C. The issuer's credit rating declines. D. The bond's market price falls below its par value. Answer, B. Interest rates fall significantly. A callable bond allows the issuer to redeem the bond before its maturity date. Issuers typically exercise this call feature when interest rates have fallen significantly since the bond was issued. By calling the existing higher coupon bonds, the issuer can then refinance its debt at a lower interest rate, reducing its borrowing costs. This feature introduces reinvestment risk for the bondholder. Question 10. In a municipal bond offering, the official statement serves as the primary disclosure document. Who is ultimately responsible for the accuracy and completeness of the official statement? A. The underwriting syndicate. B. The municipal bond attorney. C. The bond counsel. D. The issuer. Answer, D. The issuer. In a municipal bond offering, the issuer is ultimately responsible for the accuracy and completeness of the official statement, which is the disclosure document for municipal securities. While the underwriting syndicate, bond counsel, and municipal advisors play crucial roles in preparing and reviewing the document, the legal responsibility for the information rests with the municipality itself. Question 11. Which of the following would not be considered a security under the Uniform Securities Act? A. An equity REIT. B. A fixed annuity. C. A variable annuity. D. A treasury bill. Answer, B. A fixed annuity. Under the Uniform Securities Act and federal securities laws, a security is generally an investment contract where there is an expectation of profits from the efforts of others. While an equity REIT, variable annuity, and treasury bill all meet this definition, a fixed annuity does not. A fixed annuity guarantees a fixed rate of return and does not involve investment risk borne by the annuitant, making it an insurance product rather than a security. Question 12. Which of the following is a characteristic of a regulated investment company, RIC, such as a mutual fund? A. It avoids diversification to focus on high-growth industries. B. It must distribute at least 50% of its net investment income to shareholders annually to avoid taxation at the fund level. C. It must distribute at least 90% of its net investment income to shareholders annually to avoid taxation at the fund level. D. It is primarily focused on generating tax-exempt income for its investors. Answer, C. It must distribute at least 90% of its net investment income to shareholders annually to avoid taxation at the fund level. To qualify as a regulated investment company, RIC, and avoid taxation on the income it distributes, a mutual fund must distribute at least 90% of its net investment income to its shareholders annually. This conduit theory or pass-through treatment means the fund itself is not taxed, and instead, shareholders are taxed on the distributions they receive. Question 13. Under FINRA rules, all of the following are typically considered legitimate reasons for a registered representative to share in the profits and losses of a customer's account except A. The customer is a member of the representative's immediate family. B. The representative makes a proportional investment to the account based on capital contributed. C. The registered representative has obtained prior written authorization from the customer. D. The registered representative has obtained prior written authorization from the broker-dealer. Answer. A. The customer is a member of the representative's immediate family. FINRA rules generally prohibit registered representatives from sharing in the profits or losses of a customer's account, with specific exceptions. These exceptions include having prior written authorization from both the customer and the broker-dealer, and the representative sharing proportionately in the account based on their capital contribution. Simply being a family member does not waive the proportionality rule. The proportional capital contribution and written consents are still required. Question 14. An investor holding a long call option contract believes the price of the underlying stock will A. Remain stable. B. Decrease significantly. C. Increase significantly. D. Be highly volatile, but unpredictable. Answer, C. Increase significantly. A long call option gives the holder the right, but not the obligation, to buy the underlying asset at a specified price, the strike price, on or before a certain date. Investors purchase long calls when they are bullish and expect the price of the underlying stock to increase significantly. If the stock price rises above the strike price, the option becomes in the money and profitable. This strategy allows investors to profit from upward price movements with limited risk, the premium P/D. Question 15. Which of the following is true regarding breakpoints in mutual fund sales? A. Breakpoints allow investors to pay a reduced sales charge based on the amount of their investment. B. Breakpoints are illegal under FINRA rules as they favor larger investors. C. Breakpoints are only available for Class B shares. D. Breakpoints apply to all types of mutual funds regardless of the share class. Answer. A. Breakpoints allow investors to pay a reduced sales charge based on the amount of their investment. Breakpoints in mutual fund sales allow investors to qualify for a reduced sales charge as the amount of their investment increases. This incentive is available for Class A shares, which typically have front-end loads. Registered representatives must inform clients about available breakpoints to avoid breakpoint violations, which occur when a customer is sold shares at a higher sales charge than they are entitled to. Question 16. A customer who wants to ensure that their investment income keeps pace with inflation would most likely invest in which of the following? A. Treasury bills. B. Long-term corporate bonds. C. Treasury inflation-protected securities, TIPS. D. Fixed annuities. Answer, C. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are U.S. Treasury bonds designed to protect investors from inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and the interest payments are then calculated on this adjusted principal. This structure helps maintain the purchasing power of the investment, unlike fixed income instruments that are vulnerable to erosion by inflation. Question 17. Which of the following is considered an unsecured debt instrument? A. A mortgage bond. B. A collateral trust bond. C. A debenture. D. An equipment trust certificate. Answer, C. A debenture. A debenture is a type of bond that is not secured by any specific collateral or physical asset. Instead, it is backed only by the general creditworthiness and full faith and credit of the issuing corporation. Mortgage bonds, collateral trust bonds, and equipment trust certificates are all examples of secured bonds, meaning they are backed by specific assets. Question 18. A customer places an order to buy 100 shares of XYZ stock at the market. This order type means the customer wants to A. Buy at a specified price or better. B. Buy at the best available price immediately. C. Buy only if the stock falls to a certain price. D. Buy only if the stock rises to a certain price. Answer, B. Buy at the best available price immediately. A market order is an instruction to buy or sell a security immediately at the best available current price. It prioritizes execution over price, meaning the order will be filled as quickly as possible at whatever price is currently offered. This differs from limit orders, which specify a maximum buying price or a minimum selling price. Question 19. All of the following are powers of the Federal Reserve Board, FRB. Except A. Setting the discount rate. B. Regulating broker-dealers. C. Setting reserve requirements for banks. D. Engaging in open market operations. Answer, B. Regulating broker-dealers. The Federal Reserve Board, FRB, is the central bank of the United States, responsible for conducting monetary policy. Its primary tools include setting the discount rate, establishing reserve requirements for banks, and conducting open market operations, buying and selling government securities. Regulating broker-dealers, however, falls under the purview of the Securities and Exchange Commission, SEC, and FINRA. Question 20. Which of the following best describes the cooling-off period in a new securities offering? A. The period after the effective date when the underwriter determines the final price. B. The period during which the issuer's financial statements are audited. C. The period after the filing of the registration statement but before its effective date, during which no sales can be made. D. The period after the offering when investors can reconsider their purchase decisions. Answer: C. The period after the filing of the registration statement but before its effective date, during which no sales can be made. The cooling-off period refers to the time after a company files its registration statement with the SEC for a new securities offering but before the SEC declares the registration effective. During this period, typically 20 days, no sales of the new issue can be confirmed, and no money can be accepted from potential investors. However, the underwriter can distribute preliminary prospectuses, red herrings, and solicit indications of interest. Question 21. A customer holding a growth stock is primarily concerned with A. Current dividend income. B. Price stability and capital preservation. C. Future earnings potential and capital appreciation. D. Tax-exempt income. Answer: C. Future earnings potential and capital appreciation. Investors in growth stocks are primarily focused on the potential for the company's future earnings and revenues to increase significantly, leading to capital appreciation of the stock. These companies typically reinvest most of their earnings back into the business, so they often pay little to no dividends. Unlike value stocks or income investments, current income or price stability is not the main objective for growth investors. Question 22. Which of the following is a key characteristic of a municipal bond? A. Its interest income is always fully taxable at the federal, state, and local levels. B. It is issued by corporations to raise capital for business expansion. C. Its interest income is generally exempt from federal income tax. D. It is always backed by the full faith and credit of the U.S. government. Answer: C. Its interest income is generally exempt from federal income tax. A key characteristic of municipal bonds is that the interest income they generate is generally exempt from federal income tax. For residents of the issuing state or municipality, the interest may also be exempt from state and local taxes. Municipal bonds are issued by state and local governments to finance public projects and are not backed by the U.S. government. Question 23. Under the Securities Exchange Act of 1934, which of the following must be registered with the SEC? A. Investment advisors only. B. Issuers of securities only. C. Broker-dealers and exchanges. D. Only individuals selling mutual funds. Answer: C. Broker-dealers and exchanges. The Securities Exchange Act of 1934 created the SEC and governs the secondary trading of securities. It mandates the registration of various market participants, including broker-dealers and securities exchanges, to ensure fair and orderly markets. Issuers register their offerings under the Securities Act of 1933, and investment advisors register under the Investment Advisors Act of 1940. Question 24. A customer holds a bond with a coupon rate of 5% and a yield to maturity of 4.5%. This bond is trading at A. A premium. B. A discount. C. Par value. D. Its coupon rate. Answer: A. A premium. When a bond's coupon rate is higher than its yield to maturity, YTM, the bond is trading at a premium. In this scenario, the 5% coupon rate is greater than the 4.5% YTM. Conversely, if the YTM were higher than the coupon rate, the bond would be trading at a discount. If the coupon rate and YTM were equal, the bond would be trading at par. Question 25. Which of the following risks is unique to international investments and generally refers to the potential for adverse effects on investment returns due to changes in currency exchange rates? A. Political risk. B. Liquidity risk. C. Currency risk. D. Country risk. Answer: C. Currency risk. Currency risk, also known as exchange rate risk, is the specific risk that the value of an investment denominated in a foreign currency will decrease due to unfavorable changes in the exchange rate between the investor's home currency and the foreign currency. While political risk and country risk are also associated with international investments, currency risk specifically addresses the impact of foreign exchange fluctuations. Question 26. What is the primary purpose of a margin account? A. To allow customers to trade only with cash they have deposited. B. To enable customers to borrow money from the broker-dealer to purchase securities. C. To facilitate the trading of options contracts only. D. To restrict a customer's trading activity to limit risk. Answer: B. To enable customers to borrow money from the broker-dealer to purchase securities. A margin account allows customers to borrow money from their broker-dealer to purchase securities, using the purchased securities as collateral for the loan. This leverages their investment, potentially amplifying both gains and losses. In contrast, a cash account requires customers to pay for securities in full. Question 27. All of the following are typically characteristics of a Ginnie Mae, Government National Mortgage Association, pass-through security except: A. They are backed by the full faith and credit of the U.S. government. B. They are subject to prepayment risk. C. They pay interest and principal monthly. D. They are issued by Freddie Mac and Fannie Mae. Answer: D. They are issued by Freddie Mac and Fannie Mae. Ginnie Mae, GNMA, pass-through securities are unique because they are the only mortgage-backed securities explicitly backed by the full faith and credit of the U.S. government. They represent an interest in a pool of FHA-insured or VA-guaranteed mortgages. Freddie Mac, FHLMC, and Fannie Mae, FNMA, issue their own mortgage-backed securities, but these are government-sponsored enterprises, not a government agency, and their securities are not directly backed by the U.S. government. Question 28. A registered representative learns that one of their clients has been attempting to transfer funds from several different accounts into a single new account, all involving small, unreportable amounts of cash. The representative should be most concerned about: A. Churning. B. Breakpoint violations. C. Structuring. D. Free riding. Answer: C. Structuring. The scenario described strongly suggests structuring. Structuring is an illegal activity often associated with money laundering, where transactions are arranged to avoid triggering financial reporting requirements, such as the Bank Secrecy Act's Currency Transaction Report, CTR, for transactions over $10,000. Registered representatives have an obligation to report such suspicious activities. Question 29. An investor owns shares of a company's stock and wants to protect against a potential decline in the stock's price, while still benefiting from potential upside. Which option strategy would be most appropriate? A. Buy a call option. B. Sell a put option. C. Buy a put option. D. Sell a covered call. Answer: C. Buy a put option. To protect against a potential decline in a stock's price while retaining upside potential, an investor would buy a put option. Buying a put gives the investor the right to sell the underlying stock at a specified strike price, effectively setting a floor on potential losses if the stock price falls. If the stock rises, the investor still benefits from the appreciation. This strategy is known as a protective put. Question 30. Which of the following is an example of an asset-backed security, ABS? A. A corporate debenture. B. A treasury bond. C. A bond backed by credit card receivables. D. A municipal general obligation bond. Answer, C. A bond backed by credit card receivables. An asset-backed security, ABS, is a bond or note backed by a pool of assets other than traditional mortgage loans. These underlying assets can include credit card receivables, auto loans, student loans, or equipment leases. Corporate debentures, treasury bonds, and municipal general obligation bonds are backed by the issuer's creditworthiness, not a specific pool of non-mortgage assets. Question 31. What is the primary role of a clearing firm in the securities industry? A. To provide investment advice to retail clients. B. To execute trades on behalf of institutional investors. C. To handle the settlement, custody of assets, and record-keeping for transactions. D. To underwrite new issues of securities for corporations. Answer, C. To handle the settlement, custody of assets, and record-keeping for transactions. A clearing firm plays a critical role in the post-trade process of securities transactions. Its primary responsibility is to handle the settlement of trades, which includes exchanging securities for cash, and providing custody of client assets and related record-keeping functions. This ensures that transactions are properly completed and that customer funds and securities are safeguarded. Question 32. Which of the following statements about electronic communication networks, ECNs, is true? A. ECNs only execute trades for institutional investors. B. ECNs display orders and automatically match buy and sell orders without human intervention. C. ECNs are primarily used for trading less liquid, over-the-counter securities. D. ECNs provide investment advice to retail investors at a low cost. Answer, B. ECNs display orders and automatically match buy and sell orders without human intervention. Electronic communication networks, ECNs, are automated trading systems that electronically display orders and automatically match corresponding buy and sell orders. They operate 24 hours a day and are designed to provide anonymous execution and reduce transaction costs, serving both institutional and retail investors. Question 33. Which type of investment company issues a fixed number of shares that trade on exchanges and are priced based on supply and demand, often trading at a premium or discount to their NAV? A. Open-end mutual fund. B. Unit Investment Trust, UIT. C. Variable annuity. D. Closed-end fund. Answer, D. Closed-end fund. A closed-end fund issues a fixed number of shares only during an initial public offering, and these shares then trade on stock exchanges like regular common stock. Their market price is determined by supply and demand, which means they can trade at a premium or discount relative to their net asset value, NAV. In contrast, open-end mutual funds continuously issue and redeem shares at their NAV. Question 34. A broker-dealer must establish and maintain a business continuity plan, BCP, that addresses A. Only catastrophic events like natural disasters. B. Only cybersecurity breaches and data loss. C. The firm's ability to resume operations in the event of an emergency or significant business disruption. D. The firm's marketing strategies and client acquisition plans. Answer, C. The firm's ability to resume operations in the event of an emergency or significant business disruption. FINRA rules require broker-dealers to establish and maintain a business continuity plan, BCP, designed to address how the firm will respond to and recover from emergencies or significant business disruptions. A BCP ensures that the firm can continue to provide essential services, protect its clients' assets, and meet its regulatory obligations during unforeseen events, ranging from natural disasters to technological failures. Question 35. Two unmarried individuals wish to open a brokerage account where, if one owner dies, their portion of the assets passes directly to their estate rather than to the surviving account owner. Which type of account registration should they choose? A. Joint tenants with rights of survivorship, STROs. B. Tenants in common, TIC. C. Transfer on death, TOD. D. Community property. Answer, B. Tenants in common, TIC. In a tenants in common, TIC, account, each owner has a distinct, fractional interest in the account's assets. Upon the death of one owner, their share of the assets is passed on to their designated beneficiaries or estate, not automatically to the surviving account holder. In contrast, a joint tenants with rights of survivorship, STROs, account provides that the deceased owner's share passes directly to the surviving joint owners.